Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled, This is Why We Call It Worry-Free Investing. Mark Twain once said, "Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you so you can gain information, focus, and control over the situation." I've suffered a great many catastrophes in my life, but most of them never happened. Tonight I'm going to demonstrate one catastrophe, and of course I use the term relative to your worry-free investment portfolio, that would never happen if we follow Mr. Twain's sage advice. And my goal here in this presentation is to reinforce the idea that you must act when the call to action sounds. And that could be any one of several different alerts. It can be a profit objective met, an upcoming earnings report, a confirmed down call in our system, or even a sell rating on the underlying stock. Now, I want to convey the importance of this principle of taking action, and that's why I'm using another recent example here to show again why we call it worry-free investing. Now, back on November 11, 2016, I did a special presentation using the same technique I'll demonstrate here. And yeah, I know what you're thinking, not this again, but after speaking with Dr. DeLito, we feel that for the safety of your retirement portfolio, that it's important enough to continue hammering away at. But first, a recap. Remember, worry-free investing is all about building and managing a worry-free portfolio. And here's how it works. When we receive a confirmed up call in our program, it lets us know that it's okay to go out and buy high RS stocks. RS, or relative safety, in the VectorVest program is defined as companies with long-term consistency and predictability of their financial performance. The consistency and predictability. In other words, high-quality, safe stocks. When we get a confirmed down call, we simply say that it is not time to buy and we're not going to add any positions to our portfolio. And then finally, our exit criteria will be to sell stocks when the recommendation in the program equals a sell. Now, tonight's presentation will offer you an alternative to that exit strategy. Remember that worry-free investing is made up of three key principles. Number one, of course, is capital appreciation. Number two is going to be the safe, steady, growing dividends that we can collect from these high-quality stocks. And then finally, when you add selling covered calls and buying protective put options to the mix, you really have taken that step to avoid suffering through catastrophes that never have to happen. And we'll show an example in just a bit. But first, let's walk through the steps on how we find these stocks for worry-free investing. If I jump into the program, I'm going to go right up to the main toolbar and I'm going to use the Unisearch tab. And here in our Unisearch tool, we have our folders. I'm going to start and just bring up some of our very strongest searches when it comes to high RS stocks, and I'm going to start in the conservative folder. And the search that I brought up, first of all, is called Pale Blue Chips. The first thing I'm going to do is take us back to our most recent confirmed up calls so I can demonstrate the power of the relative safety concept. Now, on November 15th, we received a confirmed up call in the market. Click OK, and I run the search, and this is what the search looked like at the close of trading on the day we got a confirmed up call. Now, Pale Blue Chips is a search that finds stocks with relative safety numbers greater than or equal to 1.25 and an earnings growth rate of greater than or equal to 10% per year. Now, this is a common theme we'll see throughout these searches that I'm about to show you. So here's a list of the stocks, and let's start by running a quick test on these top 10 stocks and see how they've performed over the last 4 months. Pale Blue Chips up 13.5% versus the S&P 500, which was up just over 9%. I'm going to go ahead and move that quick test over just for a moment, and I'm going to take us to another one of our favorite searches when we're looking for high relative safety stocks. That's found in the Prudent folder, and it's called Ruler Stocks. If I run the search here, we see that Ruler Stocks also must have an earnings growth rate, in this case greater than 14%. RS has to be greater than or equal to 1.4 on that scale of 2. And again, we've got our top 10 stocks. Let's go take a look. Ruler Stocks, nice performance over the last 4 months, almost 20% versus that 9%. Slide that one over to the right. Next, also in the Prudent folder, is a search called USA's Best Growth and Income Stocks. Here, RS again has to be greater than 1.4. a growth rate parameter on earnings greater than or equal to 10%. We'll go ahead and run that search. These are the stocks that populated that list on November the 15th, our last confirmed upturn. And let's go ahead and quick test those top 10. Again, 13.85% on the best growth and income stocks. And finally, let's take it down to our retirement folder where I have two more searches I want to show you. We're going to start with Vector plus Vector 1.25. Once again, earnings growth rate and relative safety. The sort is VST plus YSG. Let's take a look. We'll quick test those top 10, 14.3% on those stocks. Slide that over one more time. And then finally, worry-free winners. This is a search that is built from a customization of our long-term winners RS descending. There were some changes made to accommodate us for selling covered calls and making sure we got dividend payouts. If we run that search as of our confirmed call, and let's quick test those top 10 as well. So again, here we're up 14.89%. Now the next process I want to use is to walk you through how to create a master watch list, again, just to reinforce how well these stocks have performed in this rising market. If I click the top stock and hold my shift key down, I can tag these stocks, right click, and I can add them to a watch list. I'm going to put them in the folder called My Watch Lists, create a new watch list, and I'm just going to title it Worry-Free Investing. Hit that, add that watch list, click OK. I've just added these top 10 stocks to a watch list. Let's go ahead and walk through these others as we go ahead and do that. I'm going to tag the top, right click, go ahead and add to watch list. The program knows that I have my watch list open. I'll just click OK. Now those 10 have been added. Click the top stock, hold down my shift key, right click, add those to this master watch list, click OK. I'll close that quick test. Let's do it with ruler stocks. Hold my shift key down, right click. We'll add these to the watch list as well. And then finally, pale blue chips. And now we have created a master watch list of 5 of our most powerful searches to find these high RS stocks. Now that I've done that, I'm going to go back up to our Viewers tab, and that brings us to our watch list section where I'm going to go find my watch list called Worry-Free Investing. And so here it is. I'll break this down so we can get a better look. And these are 26 stocks that were found. Now, I was quick testing the top 10. There should have been 50. However, we do have some crossover on the stock. So there's a total of 26 stocks found through those searches. And you can see the relative safety numbers. If I sort by relative safety, Thor Industries at the top, 1.47 is the top relative safety number. And just to take this a step further, I'm going to go ahead and graph the top 10 just to give you an idea of the type of stocks that are coming back for us here. I'm going to use the VectorVest simple layout. And for now, I'm just going to take RT and the stop price off to make a point here. So what we're looking at first, again, is Thor Industries. And I'm even going to take it back to a 5-year look. Down below are the earnings per share. And we can see over the last 5 years, the stock's earnings are rising quarter over quarter, year over year. And we see the lower left to upper right movement of the stock price in correlation with those earnings. United Healthcare, Toro Company. Now keep in mind, the fact that the earnings per share are rising along with the same graph pattern on the stocks is not a coincidence, and it's not by accident. NetEase a little choppier on their earnings, but still a price pattern moving lower left to upper right. Bank of the Ozarks, again, earnings rising, stock price rising. It's not a coincidence that these patterns correlate this way. And by the way, don't forget, over that course of time, each of these stocks are paying a dividend. If I add the dividends, there are 2 flags for each payout. It's the ex-dividend date and the payout date. And if I scroll back, we'll see that all of these stocks are paying a safe, growing, consistent dividend as we scroll through them. And remember, when you have the master watch list built, we can go down to the average down below, and we can get the average numbers on our own little mutual fund we've created here. Relative value and safety numbers are very strong. The average VST at 1.28. a comfort index of 1.37 is our average and the growth rate here. And you could even graph these and take a look, and this is what the portfolio would have looked like. Remember, we would have purchased these type of stocks back on the 15th of November of 2016, and this is what our graph would have looked like since that time. So some pretty powerful stuff. I'm going to go ahead and close that graph and go back into the slides and take us from our building the worry-free investment portfolio to the steps that we can use to manage that portfolio. And again, the technique I'm going to show here is the collar trade. Remember, it's a low-cost way to buy insurance. It allows you to protect profits and allows you to still hold on to the stock if you choose to. The collar trade consists of 3 legs. First, we are long the underlying stock. We're then going to go out and sell a covered call, and we're going to take in a premium. We're going to use that premium and apply it to the protective put or the insurance on the underlying stock. And it's critical to know when to use the collar trade. And it's ideally suited to lock in large unrealized gains in periods of market uncertainty, or again, a call to action, a reason that you determine to protect the gains that you've created. And for our example tonight, we're going to use Thor Industries. And again, we're going to begin back on November 15th of 2016. We received that confirmed up signal. Now, the worry-free winners search among the other high RS searches that we looked at would have had you purchasing Thor Industries on the next day's open, and for the sake of our example, I'm going to use the 85.67 opening price on the 16th of November. Keep in mind also that Thor Industries, THO, was the only stock that made its way onto all 5 searches that I just went through. Now, if we fast forward to March the 1st of 2017, THO closed at $113.55 per share, which leaves you with a 32% gain on your position. Now, at this point, you might ask, well, what is the alert that I have to act on? Well, through my experience of trading these and backtesting and watching the performance of these, I think we've determined that somewhere around a 30% gain might be a good time to go ahead and sell a covered call and perhaps buy the put so you can lock in the bulk of that 32% gain. Remember, our goal is to manage this portfolio and lock in these unrealized gains. Now, 32% over roughly a 4-month period is a pretty good return, and we hate to see the potential drawdown that can occur. So again, that profit objective of 30% before you take action may be one reason that you decide to place the collar trade. Now, the other reason, and this is because I know all of you do your due diligence on all of the positions you own. Okay, we know that earnings are announced on March the 6th, 2017 after the bell. And so again, that is alert number 2. That's our next call to action. I've got a stock with over 30% gain, and I know that earnings are coming out in just about a week. Now back here, the stock did gap up after earnings, which is a nice sign. But remember, at that point, I only had about a $4 or $5 gain in the stock. And so while I potentially could have bought an out-of-the-money put option to protect that for the earnings announcement, I probably would not have executed the collar trade because I didn't have the gains that were big enough to go ahead and protect at that point. So now, with THO trading at 113.55 on March 1st, let's walk through the steps we would have taken. Collar setup step number 1. With the stock at 113.55 on the 1st of March, knowing earnings are coming out in a week, we could have gone out and sold one March 120 strike covered call at $1.65. Okay, we could have sold the 115 and taking in a higher premium there, but that $1.65 premium, in my opinion, was enough to go out and sell the 120 and have the potential for the capital appreciation from 113.5 up to 120. Remember, if the stock were to take off and go above 120, it could potentially be called away from me at $120 a share, which, by the way, from our purchase price of $85.67 would be a 40% return on the trade. Collar setup step number 2 tells us again that with Thor trading at 113.55, that I would go out and I would buy one March 110 strike put option. It would cost me $2.43 per share for the option. Now remember, the collar is a low-cost way of buying insurance. So instead of paying the $2.43, I'm going to apply the $1.65 that we took in from the covered call, and we're actually going to pay 78 cents per share when applying that covered call premium that we received. 78 cents per share. That's $78 to protect an asset that you own that is currently worth $11,355. Let me say that again. $78 to protect an asset of yours that is currently worth $11,355. Okay, let's move forward. On 3/6/2017, Thor announced earnings after the bell, and the stock gapped down, and it tumbled, closing at a low of 96.70 on March 14th, 2017. Even though earnings were good, they beat their earnings estimate, top and bottom line, but they did tighten their profit margins just a touch, and that was enough to have the stock gap down and move lower over the next few trading days. So what just happened? Well, let's take a look. This is a snapshot from our options analyzer tool. And I want to walk through the consequences of either taking action or not being proactive and doing nothing. Let's start here. On the bottom line, this is the information on the stock. Remember, we bought the stock way back in November, but our trade date for the option trade was March the 1st. That's why the trade date reads March 1st. Our purchase price of the stock was $85.67, and as of the close of trading on Thursday, March 16th, the stock closed at $98.88. As I record this on March the 17th, it's actually down fractionally. So as of the close on the 16th, our gain on the stock was $1,321, or it comes out to a gain of 15.41%. That's if you had done nothing. You had owned the stock, it went from $85.67 to almost $99, and that's a great trade. But remember, this stock traded as high as $115 per share. Now, when we placed the collar trade on March the 1st, we sold this call option and we took in $1.65 or $165 per share. Currently, that option is worthless. We'll just let it expire worthless and we keep the $165. The put option that we bought for $2.43 is now worth, as of the 16th close, $11.12, which is a profit on the put option of $869. When you add the two up, it gives us a net profit on our option trade of $1,034. If we take those numbers and move into the upper left-hand corner and let's add them up, our total cost basis for the trade on both the stock and the option trade is $8,645, or $86.45 per share. The profit, when we combine the stock gain along with the options gain from the collar trade, adds up to $2,355. Those numbers add up to $11,000, or a gain of 27.24% from that adjusted cost basis of $86.45 per share. So while a 15.5% gain is very nice, with very little effort and just acting on some basic information, we're able to up that gain to over 27%. So what we've basically done is mitigated that potential drawdown. What we've actually done is lowered our cost basis of the stock down to $75 and change from the initial $85, based on that gain from the option trade. And remember, if you chose to, you still own the stock. Now, Thor Industries, we saw earlier the 5-year graph, and it pays a nice dividend, did start to turn back to the upside. You still own the stock at a very nice profit and a much lower cost basis. So if you choose to, you can continue to hold on to the stock. And remember, had the stock gone ahead and gapped up above that 120 call strike, the worst that would have happened to you is that you would have had a 40% gain in a 4-month period on this particular position. So remember what Mr. Twain said, there is really no reason to suffer through a catastrophe that never really happened. And just a final note, we have upcoming worry-free investing seminars. If you want to learn more about building and managing a worry-free portfolio, we'll be in San Diego, California, April 6th and 7th, and on May 4th and 5th, we'll be in Cleveland, Ohio. Go to www.vectorvest.com to the events tab, or call 888-658-7638 for details and to register. And as always, I thank you for taking the time.